So thrilled to be moderating a panel on investing. I think the reference is to the stock market, but it's really about investing in the panel here. Cody Sanchez, Roderick Stefan, and Michael Bonello. So first of all, really exciting to have this team of investors up here, because every one of these firms are folks that I ran into in the industry in the early days, and firms that have made a major commitment to the industry, and firms that are evolving on the fly like the industry. So what I'd love to do before we dive into a conversation on investing, obviously in the middle of what's a difficult climate, but one with enormous opportunities, I want to let our panelists give a quick introduction and on themselves and their firm, and then we'll dive right in. Michael.
Thank you. My name is Michael Bonello. I'm with Poseidon Asset Management. So we've been investing in cannabis since early 2014, got launched in 2013, launched a fund that was focused both on the public and private markets, and recently launched a second fund in the summer of last year, more focused on the private markets. But you know, it's been a whirlwind of a ride thus far, and it's just exciting to be here today, so thank you.
Thanks, Michael. Roderick.
Rod Stefan from Altitude Investment Management. We are a cannabis-only investment management firm with offices in New York and in London. I and my 5 partners have just under 25 investments that we've made over the last 3 years.
Cody. Thanks, Rod.
Hi, I'm Cody Sanchez with Entourage Effect Capital, formerly Cresco Capital. We have been investing since 2014 as well. We just launched our 3rd fund in the space and have about, just shy of 150 million in assets. I think one of the differentiators, because you kind of asked us to say what makes it different. And
absolutely, Cody. What makes you different?
These guys are killer too. We do a lot of deals with them. But I think we're going to talk about today, but one of the things Entourage Effect means in cannabis is that the sum of the parts of the cannabis plant are bigger than the whole. And so we're very much non-passive investors in this space, which I think is important today more than ever.
It's critical. And my guess is, and I know that every one of these firms, you hear about investors saying we are playing an active role in our investments, and we consider ourselves both advocates and folks that actually help the companies we invest in. So let's get to that, and I want to hear a little bit about your portfolios. But before we do that, let's talk about this winter storm for the industry and get a sense on where the group kind of feels we are in the midst of that. Just some context before we really get into, I think, hopefully some bottom-up elements of it. So, Michael, why don't you jump in and just, how do you see the duration of where we're at and, how we get out of this?
Yeah, I think a lot of variables that are driving what's going on right now. We've seen a lot of peaks and troughs in the industry over the past multiple years here. This one feels a little bit deeper. It's been systemic in that it's affecting Canadian and U.S. public companies, and I feel like the good companies are getting dragged down with maybe the not so good operators here. But I think there's a lot that's going to be at play right now. One of the things that's happening right now is a lack of cash in the industry, and capital has dried up, which you're going to see in any industry in times like this right now. And right now, what we're looking for with companies, especially on the public side of things, is companies that ultimately have a good cash balance and war chest to get through these times. One of the drivers behind what's been going on, I think, with a lot of companies has been a very aggressive cash burn. That's not anything out of the ordinary for a growth industry like this, but you had some other things at play that I think is affecting the markets. I think the regulatory aspect of the market is going a little bit slower than a lot of companies were anticipating. I think overall it's going in a very positive direction, but I think when you look at things like banking legislation, the Safe Bank Act passed, which is wonderful. Is it going to pass the Senate? We don't know, but I think if you asked someone a year ago if we'd have banking right now, they'd probably say yes. I think there's been a lot of regulatory changes that have been happening, and in terms of duration, I think we are nearing a bottom here, and I think Q1 of 2020 is going to be when we'll start to pull out of this.
So Rod, let's pick up on that, and Michael also got into some elements of I think capital allocation now, possibly even for existing investments, which is I think also a really interesting way for these folks to think about how you have portfolio investments it's a difficult environment. A lot of these companies are trying to raise capital. They need capital. Doesn't make them bad companies, as we know. So talk about the current context of the market, and talk a little bit about asset allocation within the portfolio as well.
I think in the early days, when the ecosystem was being built out, there was a lot of demand and not a lot of supply. It was very easy to build products and services, and then now we're extending them geographically. But ultimately, these are all companies. They have to produce positive cash flow. And we're seeing that even in portfolio companies. I think if most funds were honest, they'd say that not every management plan has succeeded in being realized.
Really?
Yes.
Wow. Go figure.
You know, my partners and I come from a distressed background, and we used to take advantage of debt-driven, maturity-driven restructurings. Now we're going to see a lot of capital, perhaps in existing portfolios, as well as in new companies, capital perhaps going in on a senior basis, going in as converts ahead of the equity. And those companies don't have a 6-month runway and aren't smart and astute at creating not only a base case, but a downside, and then a cash conservative case, which we demand of our portfolio companies. I think they're going to find themselves facing some challenges.
And Cody, so just try to tie a ribbon around the current investment climate. And these gentlemen have both given us a slightly different nuance to how their firm approaches it. I'm then curious also how Entourage is approaching this in terms of going out there and talking to the investment community, and how are you finding it right now going out there raising money, and what are you telling them about what's going on right now?
Yeah, there's 2 hats we wear. One, if you're an entrepreneur in the audience today, here's the bad news. The easy money days are gone. If you think you're going to raise on multiples of what you're going to do in 2020 or 2021, not going to happen. The good news is, if you put on your other hat as an investor, I don't think there's a better time to invest in cannabis than right now. The only market in which we decide that it is better to buy high and sell low is the investment market. It's really astounding. And so everybody's running for the exit right now in cannabis and retail space, and that is when, on the private equity side, we get excited. I like to see a little distress.
Blood in the streets.
Yeah, I mean, you want to see distress.
Sure, but it could get bloodier,
Yeah.
right? I mean, there's no capital. The regulatory climate is encouraging, but slow. You've got a lot of companies that were built on a foundation of capital markets that weren't really companies. And unfortunately, there's some bad apples that are. They're not spoiling the bunch, but they're making it more difficult. So in terms of, I don't need a crystal ball. None of us have it. We all understand. Everyone in the room, I think, more or less understands the headwinds. But I guess the real question is, and Rod, you brought this up. So when you put your traditional investor's hat on, and when we spoke, you used 2 really boring words when you string them together called Graham and Dodd, which I'm kidding, but this is a very traditional investment approach, which a lot of people in the room subscribe to, which talks about gross margins and free cash flow and understanding where SG&A are things that get out of whack. So, is this the reckoning that we've all been waiting for?
As a traditionally trained analyst, I ultimately do believe that a company has to return dividends or capital through cash flow to its investors. And if you look at revenues and companies slow to develop the revenue management put out, SG&A is exceeding their expectations, costs are greater, that gap is getting bigger. And when you combine the disruption we see today, but potentially in the future, let's say when it's federally legal, and a vertically integrated supply chain within each state is not economical, are you going to be able to compete and still produce positive cash flow in that changing and disruptive environment? We're still in the very early stages here. It's a bump in the road, and I agree with Cody that long term it's a great time to invest, but you've got to be cautious.
So, Michael, give us a snapshot or reach into your portfolio and give us an example of companies that are executing in this environment. I don't need names, or give us names, I don't care. But I'm curious about the core business, because I think investors want to hear either what are the subsectors where investors are actually truly seeing companies execute here, and this is not a company in your portfolio that you're particularly worried about cash flow issues.
Yeah, I think right now in the market conditions that force a lot of companies to do this is really focus on what is your core business. I think one of the things that's changed over the past year and a half is that when we're sitting down with companies and having them pitch us, they want to do just about everything: cultivation, processing, manufacturing, distribution, brands. And they're going to build out, they don't need outside data. They're going to build out their own data. They're going to get into genetics. What we're seeing good operators do now is focus on maybe one or two of those verticals and turn to outsource third-party providers for a lot of other ones. On the retail side of things, we're based in San Francisco, have a lot of investments on the West Coast, and one thing that we see in California is retailers focusing maybe on purely cultivation and retail and not getting into manufacturing, processing, and things of that nature. And so I think that's where a lot of people got today, was they're trying to do everything and burning a lot of cash. And you have to understand this industry. When you look at a vertically integrated operation, you're talking about possibly 5 incredibly different businesses. And it takes a certain level of expertise to run each one of those businesses. And so what we're seeing companies do successfully is slow down their growth, focus on purchasing, picking up assets, possibly distressed, possibly at in California retail, maybe at a trailing 12-month revenue, but slowing down that growth state game in that there's a lot to come from it. There's no reason to rush to put capital to work today. And I think, I think doing that is ultimately
Is it safe to say, though, that what I hear you saying is vertically integrated is a bad word inside your shop?
No, it's
and
not.
It's a challenge to integrate all these businesses. We all recognize also a lot of the companies have no choice, right? Depending on what state you're in and what the regulatory environment is, especially if you are somehow, attached to the plant.
Yeah, I don't think it's a bad thing by any means. In fact, most vertically integrated companies that we see will always be doing a little bit of everything along that supply chain and then turning to third-party service providers to do the rest of it. And we're seeing that a lot on the processing and manufacturing side of things.
Cody, I've had a lot of conversations with some of your colleagues and partners at Entourage that are very deep, and we've talked about the medical side of this. So again, to overgeneralize, but to get into cannabinoid and the science and investing in the part of this wonderful industry that's not only changing the world, but is going to be possibly the most profitable part in terms of multiples of where companies are going to trade. Can you talk about any of those types of investments that you have, and I think some expertise in your firm?
Sure. I mean, well, from our perspective, a couple of things. First, I think we're moving generally, whether we're talking medical or otherwise, from a desire to be acquired or a move to go public to an execution phase. And so even in the medical companies in which we're dealing with biotech and biosynthesis, for instance, which we're very interested in, I think that's the biggest change here. So companies can no longer have an expectation to be acquired. They need to actually have a path to profitability. And the interesting part is there are some real 3 standard deviation events that could happen on the medical side. We're talking about vertically integrated, but biosynthesis, for instance. So if we no longer need, mass cultivation centers because we can grow cannabis from algae or yeast at, 1/100th of the cost, then what happens to a lot of the capex that these companies have piled into cultivation?
Yeah, it is. Look, and this is the benefit of hindsight, right? Looking at investments today and thinking, boy, who was investing in this a year ago? Rod, you've never felt that, have you? I mean, Altitude's never been and said, hey, what were we thinking? But I mean, learning from mistakes, and I'm sure you've made very few, but how do you do that here? How is this year different than last year? And have you guys said, no longer are we doing X?
I think we touched on the need for cash. I think winter's coming. I think it's going to be a little bit longer than some of my colleagues think here.
Yep.
I think it's going to present a lot of opportunities, and that has caused us to rejigger our thinking right now in terms of looking at new companies that are fledgling and starting out. I think we're going to the growth stage right now of the industry, where a startup, it's going to be a lot harder to start an MSO today than it was 3 years ago, and to be competitive with some of the larger guys in the industry. So I do think we change and we are growing with the industry. As Michael pointed out, vertical integration was necessary in order to be a participant in the industry. As we evolve over time, like alcohol, you cannot be soup to nuts. You cannot be the manufacturer, the distributor, and the retail. It's going to be regulated in a way that you're going to focus on your core expertise.
So, Michael, and this kind of gets into, or I'd like to talk about brands a bit, because my view as an investor right now is I'm very nervous to invest in someone that has built up a lot of call it intellectual property attached to their brand, even though they have. And there's some great brands, and whether you're looking at high-end or flower or distribution or whatever you want to say, there are brands in this industry. We know them all. Some of the MSOs in the room have done a tremendous job of building out not only a brand as an operator, but a retail presence. And that may be a little bit different, but there are brands out there. Everyone says I've got a brand, and you should be paying X times my revenues for this brand because people know me and I have a pricing premium. That scares me because I don't think the real brands have emerged yet. I'm just curious how you guys approach this, and everybody says this is all about CPG, and yes, I think this is a very, if not now, getting there, very sophisticated consumer story.
Yeah, brands are one of the highest growth areas in this industry. There's no doubt about it, and there's a lot of room for brands to grow. I think Jason nailed it earlier in his talk about retailers really controlling the shelf space for brand. And if when we look at brands, we want the supply chain behind it, especially on the retail side of things. We know companies spending hundreds and hundreds of thousands of dollars, close to $1 million a year in slotting fees in California. Oh, yep, sorry about that. I was saying we know a lot of companies.
I'm gonna help out my friend here.
Yeah,
I'm gonna boost you up. There you go.
Thank you. A lot of companies spending branded product companies spending a lot of money for slotting fees to get on shelves in retail. And through June of this year, we were seeing 80 new branded products a week in California. And the question that we have for anyone that's a one-off branded product company, doesn't have access to retail, is ultimately how are you going to get on store shelves? You could have the best product in the world, but that doesn't matter. And retailers are really controlling that space, and a lot of retailers are trying to stock their shelves with 60 to 80% of their own products, and then filling that gap with maybe the top 20 selling products in a specific state. So brands, there's a lot of risk behind that due to the retail landscape.
Anyone else on brands? Rod, Cody, any?
I think the only thing that we have to consider is that eventually this is one of the highest margin areas of the industry. So while I totally agree with you, there has to be a unique path to distribution. We do have some brands in our portfolio that I think will get snapped up. We just invested in one called Can, which is not dissimilar to a White Claw with THC microdosing, that if you saw it on a Whole Foods shelf, you would drink it regardless. Now, I'm hesitant to make those a huge portion of our portfolio, and they have to have that incredible distribution differentiation. So I don't think you're wrong, but I think if you don't look at brands whatsoever, you're missing out on some of the long-term growth.
Anything to add, Rod?
I kind of agree that the number of brands is huge compared to those that are going to ultimately be the winners and be acquired. We're invested, for instance, in the number 2 gummy brand in California, and they're doing very well. I think if you're in the top 3 in a geography, ultimately you're going to win.
Yeah, and I think, again, each geography has different elements of structurally regulatory why those brands are coming to the top, and a lot of it comes back to how these companies have effectively vertically integrated. So let's talk a little bit about the top down, because again, we all know that the top down story that we're all focused on in terms of growth and this sophisticated CPG story, but in the short run, the top-down is dictated by the regulatory environment. So I want to get into this a little deeper. And when you show up at work in the morning, and you get into your conference room with your colleagues, and you talk about these moments and what catalysts will mean for the industry in your portfolio, I kind of want to know. And in many cases, you also have companies in your portfolio that are running scared of legislation, right? In other words, I don't mean that they're doing something wrong. I mean that they are not ready for descheduling. They are not ready for full safe banking and capital markets. They're not ready for the FDA to fully sign off on the rules and regs around putting food additives. So who wants to talk about those dynamics as they affect your portfolio? And I'd like to hear how you would rank what could be catalysts out there in terms of how important they are. Whether they are things like SAFE Act, States Act, FDA, you tell me. I think people would like to hear how you see them.
I'd be glad to start.
Go ahead.
I think everybody is looking at the States Act being approved, as we all know, through the House, and then hopefully eventually through the Senate is probably the first big move. That would eliminate a lot of challenges associated with banking, a lot of the crime associated with cash in the industry. Clearly, the States, the Claims Act for insurance, and then the States Act, which would allow people under state law, as long as they're conforming, not to risk prosecution from the feds. I think that's going to be huge. It's going to be gigantic. The NAIC put forth a platform last month, which really addressed not only the cash aspect, it addressed a nutraceutical pathway, a pharmaceutical pathway, and then shutting down the illegal market. And I think, unfortunately, we're going to do the step-by-step approach, but a comprehensive deregulation probably is what the industry needs to solve all the problems.
Michael.
Yeah, the regulatory environment is definitely constraining. We passed the SAFE Act, which is great. Whether it gets through the Senate or not, I don't know. But I think one of the biggest things for companies out there is you have to be overly flexible when it comes to regulations, because we've seen it happen over and over again in the industry when things change overnight. There's a black swan out there with what's going on with vaping right now that's piling onto the sell-off in the public markets. Is definitely not helping things by any means. And so you might have regulation behind that, but we're still awaiting CBD, FDA guidelines on CBD and Department of Agricultural guidelines on hemp growing, so we're awaiting that. So ultimately, you have to always think about these things and look at every case possible or scenario possible in terms of how this is going to play out. And you really can't make bets on regulation. You can just absolutely get burned by that. One of the things that I've seen in the past couple weeks, we're seeing Mexico come out with their guidelines for their laws. Germany recently said that they'd like to do all their cultivation within the country within a few years. That's changed, I think, for a lot of suppliers in North America that were possibly supplying countries like that. The bottom line is that it's ever changing, and for anyone who's been in this industry for even more than 6 months or so, it's nonstop.
This is the opportunity and the challenge, Cody. How do you view it? And is there any seminal moment that you think I'm gonna know where I was when I heard that came out?
Well, the most important thing from my perspective is 280E, is the taxation burden on these companies. And so safe banking doesn't actually fix that. So, we sit on the board of the Marijuana Policy Project and the CFT, or CTF, Cannabis Trade Federation. So check both of those if you want to actually see a play-by-play on what's happening with regulation.
Doing a great job there.
Great job. But from that perspective, I'm actually interested in what California is doing right now. They have legislation on the table to essentially allow for a little bit of leniency to Californian cannabis companies from a tax perspective. And so the biggest thing to me would be these companies are being throttled by taxation, and if we could alleviate some of that burden, I think the industry would get a huge uptick.
Do you think, so that sounds to me just as simple as descheduling, which isn't simple.
Yeah, exactly. Exactly.
Could you see that getting hived off and finding a solution before they have to solve the full Schedule 1?
Well, I think states could do it on a state-by-state basis. They can't do it.
This is States Act stuff.
States Act stuff, or if California, which is the largest cannabis market, does actually pass legislation that allows for some allowances on state taxes, because they have a huge state tax burden. So I don't think it fixes anything, but that would give an uptick to a state that has been really aggressive on corporate taxes overall.
Yeah, I mean, the irony is that the illicit businesses have never been more profitable.
Yep.
It's never been a bigger environment. So we've got a minute and a half left, so I'm going to give you all 30 seconds or so to either talk about outlook. We haven't really talked about global versus domestic. We haven't really talked about, Rod, I thought you brought up something very interesting as it relates to just your background is kind of as a distressed guy. I mean, where are traditional distressed investors? But I won't anyway. So Michael, the floor is yours, and thank you.
Thank you. The way we see things going forward right now, when you talk about regulation, I think the biggest driver is going to be the presidential election in 2020. We might get SAFE passed, but I don't know if there's going to be any meaningful legislation past that. And to Tim's point, right now, the regulatory environment is driving the black market. And you can look at this at two ways. You can look at it as a huge negative, which it definitely is, but it's also providing opportunity for a number of companies to take advantage and get established in states like California that have 2,800 illegal dispensaries, 200 illegal businesses, as Cody was mentioning. The regulatory climate has to change. I think that it's way too costly, it's been way too slow to roll out, and it's too fragmented. We really need something to change on a federal level for anything meaningful to happen.
Let's hope. Robert.
I think looking forward, we have to recognize the great opportunity this is. We've heard how USA is lower multiples than Canada. I'll just throw out Europe. Europe is the new opportunity where it's fledgling and there's great opportunities to get involved at even lower multiples.
Great. Thank you. Cody.
Yeah, all I would add is, again, keep an eye on valuations. I think 12 to 18 months of runway we need to see in companies. I do think there's great opportunity here in the U.S. We're largely focused on the U.S. market. I think the risk-reward trade-off is best here, although we are looking at Europe too. And the only thing that I would add is that these cannabis companies, we are in a unique position which we will not be post-legislation change, which is they're capital starved. So if you have capital play, you have an unfair advantage now that you will not have afterwards when it might be more of a binary trade.
It's a huge opportunity to have cash right now. So, because I'm a stickler for scheduling, because you could see I got here on time for my first panel, we're going to end it here. So, Michael, Rod, Cody, thank you very much. Really interesting.